If you were born before 1966, there is a very good chance your bank has already changed something about your savings account and never called you, never mailed you a clear notice, and never sat you down to explain it. Stay with me for the next few minutes because by the end of this video, you'll know exactly what to check in your own account today, and one of these 3 changes could be quietly costing you real money right now. If you were born before 1966, I want you to stop scrolling for just a moment, because what I'm about to walk you through could directly affect the money sitting in your savings account right now. Over the last few years, banks across the country have been reworking the fine print on savings accounts, and the people most affected by these shifts tend to be older savers, the generation that opened their accounts decades ago, back when banking meant walking into a branch, shaking a manager's hand, and trusting that the rules you signed up for would basically stay the rules. That world has changed. Today I'm going to walk you through 3 areas where account terms have shifted in ways that many longtime savers have simply never been told about in plain language. Why these shifts matter more if you opened your account a long time ago and what you can actually do about it. This isn't about fear for the sake of fear. It's about making sure you're not the last person in the room to find out the terms of your own account have moved. Let's start with the first area, and it has to do with how banks handle low balances and account activity. For decades, a lot of savings accounts were opened with the understanding that as long as you had money in there, the account just sat quietly and did its job. But over time, many banks have introduced or tightened rules around minimum balances, monthly maintenance charges, and what counts as an active account. If a savings account dips below a certain threshold, or if it goes a certain number of months without a deposit or withdrawal, some institutions will begin applying a monthly fee that simply wasn't there when the account was first opened or wasn't enforced as strictly. For someone who opened an account in the 1970s or 1980s and has treated it as a safe, stable place to store money for emergencies or for later years, this can be a quiet erosion. You're not spending the money. You're not making risky choices with it. And yet the balance can be smaller at the end of the year than it was at the beginning, purely because of fees tied to inactivity or balance minimums that were adjusted long after the account was opened. The reason this hits older savers harder is straightforward. Younger account holders tend to open new accounts more often, compare offers, and move their money around, which naturally keeps them exposed to current terms. Longtime savers, especially those who value loyalty and stability, are far more likely to still be sitting on an account whose terms were set years or even decades ago, and whose updates arrived buried in a paragraph of a mailed notice that easily got set aside with the rest of the mail. The fix here isn't complicated, but it does require a few minutes of attention. Log into your account or ask for a printed statement, and specifically look for language about minimum balance requirements, monthly maintenance fees, and any mention of dormant or inactive account status. If you see a fee you don't recognize, call the bank and ask directly when that fee was introduced and whether your account qualifies for a waiver, because many banks do offer waivers for seniors or for accounts linked to a checking account, but they generally will not volunteer that information unless you ask. The second area involves something a little more subtle, and it has to do with how interest is calculated and how often it's paid out. When many people opened their savings accounts years ago, interest was often calculated on the full balance and credited on a predictable schedule, and the rate itself, while modest, at least felt like it was working in your favor in a simple, understandable way. Over time, some institutions have shifted toward tiered interest structures, where the rate you actually earn depends on how much money is in the account, meaning a saver with a modest, steady balance may now be earning a noticeably lower effective rate than someone with a much larger balance, even though both are technically holding the same type of account. On top of that, some banks have changed how frequently interest compounds, or have adjusted the fine print around what triggers a rate change, so that the number printed on your monthly statement doesn't tell the whole story unless you understand the tier you're actually sitting in. This matters enormously for older savers because many of you built these accounts specifically as a steady, low-risk place to let money grow slowly over time, often as a supplement to retirement income or as an emergency cushion. If the effective rate on your balance has quietly slipped into a lower tier, The account can still look like it's doing its job on the surface, while actually underperforming what it once did, or underperforming what a newer account at the same bank might offer. The way to check this is to ask your bank for the exact tier structure that applies to your account balance, not just the headline rate advertised in their lobby or on their website, because that headline rate is very often reserved for the highest balance tier only. It is also worth asking whether the bank has introduced any new savings products since you opened your account, because it is common for institutions to keep older accounts on legacy terms while promoting newer accounts with better rates to new customers, meaning loyal long-term customers can end up earning less than someone who just walked in the door. The third area is the one that tends to surprise people the most, and it involves beneficiary designations, joint account rules, and how the bank handles the account when something happens to the primary account holder. Decades ago, a lot of savings accounts were opened with fairly informal arrangements, sometimes with a spouse listed jointly, sometimes with verbal understandings within a family about who the money was meant for, and sometimes with a payable on death designation that was filled out once and never looked at again. Many banks have since updated their internal policies around how these designations are recorded, verified, and honored, partly due to changes in banking regulations and partly due to internal risk management updates. This means that a beneficiary form filled out 30 or 40 years ago may no longer be on file in the way you assume, may have been affected by a merger if your bank was acquired by another institution at some point, or may simply not reflect current family circumstances like a divorce, a remarriage, or the passing of a person who was originally named. For someone born before 1966, this is especially relevant because you are statistically more likely to be thinking about how these accounts will pass to a spouse, children, or grandchildren, and the assumption that it's already handled can be a costly one if the paperwork on file doesn't match what you believe is in place. Banks have also, in many cases, updated the rules around what a joint account holder can and cannot do independently, including withdrawal limits or notification requirements, and these updates don't always get communicated clearly to account holders who have had the account for a very long time. The practical step here is simple but important. Request written confirmation from your bank of exactly who is listed as a beneficiary or joint holder on your savings account, and compare that to what you believe should be listed. Do this once a year if you can, because it costs nothing, takes a phone call or a branch visit, and can prevent a genuinely painful situation for your family later on. Now, I want to be clear about something, because I think it's important to say directly. Every bank is different, every account is different, and the specific fees, rates, and policies that apply to you depend entirely on your institution, your account type, and the state you live in. I'm not telling you that your particular bank has definitely done any one of these three things, and I'm not a financial advisor giving you personalized advice. What I am telling you is that these are three categories where changes have become increasingly common across the industry, where older accounts are statistically more likely to be affected because they were opened under older terms, and where the responsibility to notice these changes has quietly shifted onto the account holder, because regulations generally require disclosure, but they don't always require the kind of clear, plain language explanation that would actually get your attention. That's exactly why the smartest move you can make this week isn't to panic, it's to get curious. Call your bank, or better yet, walk into a branch if you have one nearby, and ask 3 specific questions. Ask what the current minimum balance and fee structure is on your specific account. Ask what interest tier your current balance falls into and what the actual effective rate is, not the advertised headline rate. And ask for written confirmation of the beneficiary and joint holder information currently on file. Write down the answers, keep them somewhere safe, and if anything feels off compared to what you remember agreeing to, ask directly when that change happened and why you weren't notified in a way you actually understood. I also want to gently push back on the instinct some people have to assume, "My bank wouldn't do that to me," or "I've been with them for 40 years. They know me." Loyalty is a wonderful thing between people, but banks are large institutions operating under policies set at a corporate level, and even the friendliest local branch manager is generally following rules handed down from far above their pay grade. This isn't a story about any one bank being dishonest. It's a story about how the banking industry as a whole has evolved, how disclosure requirements technically get satisfied through dense mailed notices that are easy to overlook, and how the burden of staying informed has shifted onto customers, especially long-tenured customers who have the most reason to assume nothing has changed. The generation born before 1966 grew up in an era of handshake trust with local banks, and that instinct served people well for a long time. But the accounts you opened decades ago now exist inside a very different regulatory and competitive environment, and a few minutes of proactive checking can protect money you've spent a lifetime carefully setting aside. Before you go, I want you to do one thing today, not next month, not when you have time, but today if you can manage it. Pull up your savings account online or find your most recent paper statement, and just look at three things: the fee section, the interest rate section, and the account holder or beneficiary section. That's it. You don't need to make any decisions right now. You just need information, because information is what lets you make a good decision later instead of an emotional one under pressure. If something looks unfamiliar, write it down and call your bank this week. Most of the time, the answer will be reassuring, but every so often it isn't, and catching that early is the entire difference between a small adjustment and a genuinely painful surprise years down the road. If this video just helped you look at your own savings account a little differently, do me one favor before you go. Hit that subscribe button right now, because every single week I'm breaking down exactly this kind of thing. The quiet changes, the fine print, the stuff that affects your money but never gets explained to you in plain English. I'm not here to sell you anything or scare you into a decision. I'm here to make sure you're never the last person in the room to find out something important changed. So if you found even one part of this video useful, subscribing means you won't miss the next one, and it genuinely helps this channel keep making videos like this for people who deserve straight answers instead of confusing paperwork. Tap subscribe, turn on notifications if you can, and I'll see you in the next video.